Welcome everybody. Conversation with Elad Gil, serial entrepreneur and executive. I think as most people here know, but maybe for the broader audience, Elad's co-founder of Color Genomics, was previously vice president at Twitter, and Elad is literally one of the best investors of all time. I think most people don't. Everybody sort of knows like a little sprinkling of the portfolio, but it's Airbnb, Pinterest, Wish, Instacart, Square, Coinbase. Like you run through the list and you have to like talk for a long time to get rid of the $10 billion companies and then get to like the $1 billion companies, which is pretty remarkable. It's literally one of the best angel investors of all time. And is also the author of the now best-selling book, High Growth Handbook, which we have copies of for everybody. So grab one on your way out. Make Elad sign it. So Elad, thanks for joining us today.
Thanks for having me.
Of course. Maybe you want to just introduce yourself? I don't know if I missed you.
Oh my God. I don't think I can top that. It's like
It was all true.
You did a phone call with my mom or something, and she's like, "Avichal, you got to talk good about my kid." So let's see. So I've started two companies. One was an early data infrastructure company that Twitter bought. One was Color. As Avichal mentioned, have been lucky to invest in a handful of good companies, and
It's an understatement.
and super bullish on crypto. So excited to see a lot of friendly faces here from that community.
Great. Okay, so maybe we can start with, I thought you have the CEO experience and the founder experience and then the investor experience, and so we can talk about both, but maybe we can start with the CEO founder side of things. So maybe we can just start with your most recent CEO experiences. How did Color happen? Like, what was the backstory around Color, and how did you decide to do that?
Sure. I think Color was ultimately really driven by the personal story of my co-founder, Ottman. So he is very open with the fact that he's a BRCA2 carrier, which means he's at higher risk for certain hereditary types of cancer. And multiple family members of his have either had cancer or passed away from the disease. And at the time when we started the company, most genetic tests cost many thousands of dollars. And so the idea was, could you actually create more access in a user-friendly way for people to be able to understand really important aspects of their health. And so the genesis of the company was really his personal story. And he's been CEO of the company for almost 3 years now. And it made a lot of sense for him to sort of take over because he had such a strong personal connection to what the company's doing.
That makes sense. So I know you write a lot about this in your book, but can you talk about some of the key skills that you think the CEO needs to actually be successful? I mean, there are a lot of CEOs today, so.
I feel like there's almost two separable things. There's the skills that are needed to be successful, and then there's the things you should focus on. And I think those may be separable, but a lot of people sort of conflate them. I think ultimately the things that you need to focus on are the things that the CEO uniquely has to do. And obviously it changes with the scale of a company, right? If you're two people, you just need to build a product and sell it, and that's it. And there's nothing else you should really be doing in some sense. If you're a dozen people or a few dozen people, then a lot of the emphasis kind of shifts in terms of number one, making sure that the company's properly capitalized, it has the money to do the things it needs to do. Number two, it's pointed in the right direction. Number three, it can attract, train, and retain great talent and allocate them against those resources or those things that you want to accomplish or those goals. And then lastly, I think one thing that's under talked about is sort of the chief psychologist role that a lot of CEOs end up playing, where a lot of members of your team will at different times be unhappy about certain things or want to talk through certain things, either from a personal, emotional, or sort of work perspective. And so you have to do a lot more of that than I think a lot of founders realize. And that kind of shifts with time because eventually you build out an executive team and they start taking on more and more of that burden or that sort of role or task. If you think about it, if you're running a 100-person company and each person has a bad day 3 times a year, every day somebody's having a terrible day. And so that means that you end up in a lot of those sort of situations. So I think from a what you should be doing perspective, those are sort of the main things. I guess the other one is, obviously representing the company externally. It could be for sales, partnerships, press, whatever. And so I think that's sort of the role side. I think the most under-talked skill sets in Silicon Valley, at least, because often when people talk about founders now, they talk about how technical the founder has to be and how smart they have to be as an engineer. And I think in reality, there's been sort of an underappreciation more recently of sort of the commercial side. And the fact that, if you're running a business, you should actually start to understand business. And you should, really do a crash course in that. And then I think the other big thing is sales. If you think about it, as a founder, you're constantly selling. You're selling employees to join you. You're selling venture capitalists to give you money. You're selling your customers to use you. So I think, when all is said and done, probably the biggest thing a CEO does is sell. But nobody ever talks about that as really the primary skill set that you're going to need.
You also have this part in your book where you talk about managing yourself. Can you talk a little bit about like the CEO skill set around managing yourself?
Sure. Yeah. No. I think often what people do is they don't think about all the things that they should be doing in their life to make sure that they can actually continue and thrive in the role. And so one aspect of that is, what are the things that you absolutely hate doing, and can you hire somebody to do those things for you? So, one is offloading, which is why you often see CEOs at a certain scale start to bring in COOs, because they don't want to deal with certain aspects of the business, or alternatively, they just want a thought partner who's run things at scale before, who can really sort of help out with things. One is sort of ensuring that you're getting sleep, you're exercising, you're eating well, you're doing date night with your significant other, all the things that sort of get lost as things get more and more intense. And you often see people burning out either because they don't take that time to effectively take care of themselves. And by the way, I'm a workaholic, so I don't mean you should be lounging with cocktails it's not like, I don't know if anybody here has visited a WeWork where they have like Margarita Mondays and then like Taco Tuesdays, and it just seems like such a chill environment. I don't mean that, because I think you have to work hard to succeed, with some exceptions. But I do think you need to make sure to sort of create that time so that you can recharge and you actually have that space. And so some founders I know fall into hero mode, where they'll do the 6 a.m. customer call. And you're like, well, if the person's willing to talk to you at 6 a.m. because they're on the East Coast, you can talk to them at noon their time. It doesn't have to be 9 a.m., right? And so I see people kind of self-sacrifice almost too much relative to the role in ways that just aren't smart.
Yeah. Are there CEOs that you think of that you think are just exceptional at this, that they've like managed to find that right balance?
I think balance really means there are periods where you work really intensely and periods where you take some time or a break, versus every day you need that 3 hours of downtime or me time or whatever it is. And so I think it really is about modulating the ebbs and flows of it. I think Patrick and John at Stripe are really good at it. I think there's a few founders who are pretty good at it.
That's right. You also talked about this idea of like CEOs bring on COOs as the company scale. Over the last 10 or 15 years, have you seen that change or evolve, or how has that changed and evolved?
Yeah, it's a great question. It's been a massive shift. And so if you go back to the 90s, what would happen is venture capitalists would invest in a company, and one of the first things that they would often do is they'd get rid of the founder CEO, and they'd bring in a hired gun to come run the company. This still happens in biotech, by the way, pretty frequently. So many founders ended up just not running their own companies. And so the companies were less innovative. They were less willing to sort of break glass on things that they'd sort of thought were dogma but were wrong. That all shifted in the mid-2000s when Sheryl Sandberg joined Facebook. And that created a whole new model for the fact that you could hire a COO instead of having to have somebody come in and replace you. And the primary reason that Zuck was able to get away with that is because he had board control. And the primary reason he had board control is because Sean Parker got fired from a company called Plaxo that I used to work at the time when Sean was there. I was a consultant to the company. And Parker then convinced Zuck that he should really sort of build out a real board. He should have control of the board so that he couldn't get fired. And then Sheryl got hired as COO. That worked magically. And then that became the pattern for every other company since then. So if you even look at something like Google, Eric Schmidt came in as the CEO, and Larry and Sergey really dragged their feet on it, right? It took them a year or two to hire a CEO. They always found something wrong with each candidate. If you think about the people who kept running their own companies in the 90s, or 80s and 90s, it's people who bootstrapped. So it was Microsoft, right? Bill Gates kept running his own company because he never really raised external capital. Or Michael Dell effectively bootstrapped. And so it's interesting to see that big transition happen.
Yeah, interesting. Do you have any color or backstory on how Eric Schmidt happened then? I mean, they dragged their feet for 2 years. Like, how did?
They dragged their feet for a while. I don't know if it was 2 years or 1 year, but it was a while relative to the search. And I think the rumor is that, I can't remember if it was Mike Moritz or John Doerr, they were both on the board. One of them threatened to quit if they didn't just hire the CEO, right? They're like, just fill the role already. And I think what happened is Eric has a PhD in CS, so he's actually quite technical. And then secondly, I think he was already going to Burning Man, and so that was a big, okay, he's a burner, and so it's okay, like he's not a real CEO.
Well, and also he was CTO at Sun, right? He wasn't even CEO, and so it's kind of an interesting thing.
Well, he was CEO of Novell after that, I think.
Gotcha. That's pretty funny. So if you look at that in a crypto context, do you think that there are different or unique skills that crypto CEOs need relative to non-crypto CEOs, or do you think that basically carries over? Or Yeah, how do you think about crypto CEOs?
I think it's more or less the same, although I think some folks may disagree, and maybe as we get later in the conversation, I'd love to hear the disagreement. But from my perspective, I think it's the same role, and you have to fundamentally do the same things. You need to build a great product. You need to hire great people. You need to raise money. You know, if you tick through the list, you need to find people to use your product or speculate on it at least, depending on your perspective. So you know, it's the same set of things. Yeah. And I think one of the big disservices that was done to the early crypto protocols, especially the layer 1 ones, was the degree to which a lot of the early investors didn't have strong operating backgrounds and or encouraged people to do really weird things in terms of governance, in terms of, hey, let's set up a foundation in Zug, as well as have like the company have some tokens, as well as, I mean, you started splitting sort of incentives and who's doing what in all sorts of weird ways. And so I think there's actually lots of bad advice given either for tax optimization or just, hey, it's a decentralized world, so everything sort of follows. And I think in reality, when all is said and done, you know, most effective teams need process, and most effective teams, you know, function well in certain ways that just our standard corporate structures provide. It doesn't need to be a standard corporate structure, but you know, there's lots of lessons that can be learned.
Yeah. So, kind of riffing on that a second. So, how do you think about organizational structure, more generally, kind of outside crypto, and then we can bring it back to kind of crypto context? How do you think about structuring a company and the org structure that actually goes into making a successful company?
Yeah, it depends on the scale of the company. So when you're 5 people, you don't have much of an org structure, right? Like everybody reports to the CEO or something. When you start to scale, I think org structure is ultimately driven by 3 things. Number 1 is, who do you have on your team? So it's really a pragmatic exercise. Like, is that person able to carry on that function? And if you have a big gap, who can fill that gap, right? So it's a very pragmatic thing. And so, for example, at Twitter, Alex McGilvory, who was the general counsel, at different times owned M&A. He owned customer support. He owned trust and safety. He owned all these random things that a GC would never own, simply because he had the bandwidth and he was good and he was a good people manager. And then the second the person to run that function came in, they'd hand it off to that person, right? And so he's a gap filler in terms of, you know, those functional areas. So number 1 is pragmatism. Number 2 is, who's on the team and available, and do they have the bandwidth, and can they do it for some period of time? And then number 3 is, where do you want tie breaking to happen? And so if you think about it, you're kind of deciding through org structure, where do you want people to make decisions below you on what? And so if product and engineering report into the same person, a lot of those disputes will get resolved by the person that both of those things report into. If it reports into you as CEO, you're the one who has to sort of mediate, right? And so I view corporate hierarchies in part as a reflection of where you want decision-making to lie in the organization.
Yeah, makes sense. Can you talk a little bit about this gap filler concept? I know it's something you talked about before, and a lot of companies have somebody like that.
Yeah, I think it's a great concept both early and late. I think early, when you're 5 to 10 people, it's probably worth just hiring somebody to dive in and just do all the things that need to get done in a company that you can effectively delegate to a smart, hungry person. And so, you know, we had somebody that you referred to us, actually, at Color, who did that. And a lot of companies I know sort of bring in that person. They can do everything from office management to the first marketing deck to, you know, setting up payroll to whatever's needed to get done to sort of be successful. I think as a company gets later, people sometimes either have a COO do that, sometimes they have a biz ops team, which is really effectively an internal consulting org, or sometimes they'll have a chief of staff, and that'll effectively be like a larger company gap filler.
Yeah, and it's really, I mean, a lot of really successful, I didn't realize AMAC at Twitter kind of played that role, but like Chris Cox did that at Facebook. He sort of like jumped in a bunch of different places and sort of just took over the org for a while and fixed it and then handed it off. Or Solar, I think, did that at Google.
Yeah, Ruchi did that at Dropbox. So I think every company as it scales has at least one of those people, and often they're most needed when you don't have a real executive layer or you're building it out and you need somebody to say, okay, now go fix HR, now go fix recruiting, now go fix, you know, finance. And they're people who may not be versed in it, but they're smart, and they can just sort of hold down the fort for a little while and help hire in the person that will take it over.
You have tips or ideas on how you can identify those people? Or, I mean, it seems like it's like a unicorn. How do you even find those people?
Yeah, I think they need 3 characteristics. Number 1 is...
Somehow I'm not surprised that you have exactly 3 characteristics.
Yeah, I really have 2, but I'll make up the 3rd. So, you know, got to keep charging ahead and always outdoing the numbers. So number 1 is they need to have the trust of the CEO or founders. Because if they don't, because they're in a really precarious situation, right? They're coming in and they're trying to fix something that's probably broken, because when things scale really rapidly, everything breaks, and that's normal. And so it's probably broken, and the people there may not be happy that this person's parachuting in, And the CEO may have a very strong mindset about how to do things. One of the things I'm always surprised by, not surprised, I mean, it makes sense, is if you think about it, if you have an engineering founder, then they're never going to doubt or question engineering processes. They're like, oh yeah, of course we do code reviews, or oh yeah, of course, we're going to have these types of scrums. But they often want to reinvent every other part of the business. We need to reinvent HR, and we need to reinvent sales. I mean, these aren't real things. They're liberal arts people, like what do they know? And so I think that there's this really strong perception that those things aren't their own disciplines, and they are. And there's been, 40 years of enterprise sales for software that works really well. Like, you shouldn't go and make up some shit. There's one well-known company that for years didn't think that there should be variable comp for salespeople because engineers didn't get it. And so they didn't do it, and their sales team was awful. And that was one of the reasons. And so, I think the first thing you need is that trust of the founder or CEO, because they're going to trust you to say, you know what, we should just do the standard stuff here. And we can try and invent stuff along the edges, but let's just try it this way for a while. So that's one. So they need that trust. Two, they need to be low ego, because they're going to hand off stuff and they're not going to power build definitionally. So that's really important. And then third, they need to be sort of logical, analytical, calm. The people that they are working with need to sort of feel at ease around them and feel like they're doing things for the right reasons. I think Sundar at Google was a great example of that, where he was always, whenever you were in a meeting with him, he would always be focused on doing the right thing for Google, not for himself. And so that caused a lot of trust in the organization for him.
Interesting. Do you have thoughts on how you identify those people? Those are great characteristics, but are there like patterns to where you find these people, or are they truly unicorns and they just sort of like?
I feel like they kind of self-emerge, because effectively what I've seen happen is often the founders start building more and more trust in an individual over time, and they see them being successful in things, and then eventually they just start throwing them into things to help. So I think often it's organic if it's truly like somebody who's running corporate strategy or something. Sometimes you'll hire the person in. So for example, Square did that for BizOps, where they explicitly hired somebody in to come and do internal consulting and do that as sort of a function.
Gotcha. So maybe that's a good segue into hiring, and I know you have lots of thoughts around kind of recruiting and hiring best practices. Can you talk through kind of how you think about just hiring and recruiting generally?
Yeah, I think, honestly, the recruiting advice that I tend to give is very tactical, which may be bad. I think it's good, but I don't have any platitudes for anybody. A players hire A players. Like, what do you do with that? That's completely worthless. And so I think a lot of the things are pretty simple, and you folks are probably doing it. Number one, write up a role definition. What are you actually trying to hire for, and is there agreement on what you're trying to hire for across the set of people who are interviewing that person? And you'd be surprised by the number of times where people interpret roles very differently. You say, hey, we're going to hire a BD person, and people may have no idea what you mean by that. So number one is sort of level setting, writing it up, discussing with the people we're interviewing, what are we actually looking for. Number two is casting a wide net in terms of the set of people that you're trying to pursue. So, and then three is having a fast process. So if you look at the primary advantage that a startup has against an incumbent when it comes to hiring or recruiting, in some sense it's speed. The faster you can get an offer to somebody, the more likely you are to close them. And so I think those fast turn times actually matter a lot. And also the candidate feels like you're moving them along and you're excited about them versus, hey, I forgot about you and it's 2 weeks later and let me ping you, and it just doesn't come across the right way. And in general, I think that maps into like making it feel professional. Do you send them an offer letter? Is it signed by you? Like, what are the little things that make it feel like you're a bigger organization than you are from the perspective of somebody who's taking risk in terms of joining you? Now, don't get me wrong. Sometimes people are just like, I just want to go to a startup and I'm super excited that it's chaotic, but most people aren't that way. And I think one of the biggest mistakes I see founders make, including myself in different periods when I was a founder, especially with my first company, is you project your own willingness and excitement around chaos onto everybody else, right? And so as a founder, you're like, this is awesome. I get to do my own thing and people figure things out and it's so much fun. And most people aren't like that. They want structure, they want clarity, they want to know what they're doing, they want to know where they're heading, they want to know what the goals are, they want to feel safe, And so part of your role, I think, as a CEO is providing all those things. And part of that comes through in the hiring process as well. And then there's other little things, like do you pre-vet who's going to ask what question consistently, and there's a bunch of tactics, but
which are covered in the book, which everybody should read.
Oh yeah, thanks. It's all in here. So, thanks for the plug.
Is there a company that you think does a particularly exceptional job at this? Like, is there some model out there where you say, wow, these people just really nailed it?
I don't know. Yeah, I haven't looked at it closely. So I feel like these things change. Like some hiring processes that used to be really fast have really ossified. And I think some of them are also circumstantial. Like Google used to make sure that each person had at least 8 interviews before they'd let them in the door. And that worked really well in an environment where they were the primary company hiring all the talent, right? Like if you're in a recession, you can do whatever you want.
I know you have some pretty strong views around product market fit too. How do you think about hiring relative to product market fit, and like how these things kind of interplay with each other too?
Yeah, I think there's, at the extremes, 2 types of startups, right? There's sort of the fat startup. You need to raise, $100 million just to get off the ground and do certain things. And then there's sort of the standard lean startup of it's 2 people and you're trying to sort things out. I think in general, it depends on how strong you think your product market fit is. So, as you add people, it gets harder and harder to change direction. But also, the people who start joining you are more and more risk averse and less likely to want to go through a giant discovery. And they may also eventually feel a little bit resentful if you really don't know what you're doing. And they have a 10th of the equity that you do, or a 50th of the equity. Although we can get back to why I actually think founders. There's I think a lot of memes in Silicon Valley around how early engineers really suffer relative to founders from an equity perspective, and I think that's totally false.
Can you talk about that?
Sure. I think being a founder is a lot harder than people think. I think raising money is, despite the environment, you see all sorts of things not get funded today. And so I think if you've raised money, you've set direction, you've convinced people to join, you've actually already helped create something valuable. And you've created momentum in a certain direction. And often early investors will invest behind the person, not just behind the idea. And so people are betting on you. And I think that almost every founder I know eventually starts complaining about the fact that they're working harder than their employees. And I do think founders on average work harder. I think they suffer more stress because it's a really stressful job and you feel the weight of your employees' future lives on you. And you also shield employees from a lot of stuff that they don't see. And a lot of the crap they have to deal with, either from an HR perspective or from an investor perspective or whatever it is. Like some people tend to act badly and you have to deal with it as the CEO in ways that a lot of people in the company just never get exposed to. So I think it's more stress, you're taking on more risk, and you've set direction and people are effectively betting on you. Versus somebody who joins and could leave at any time, and honestly, nothing is tying them to the company. They haven't raised money, so there isn't the investor pressure to say, hey, you have to stick around. They're just not on the line in the same way.
Yeah, it's funny. I actually didn't know that you thought that. I tweeted a similar thing out like a month or 2 ago. And the responses that came back was so fascinating because it's almost universally anybody who started a company agreed with it. Yeah. And anybody who had not started a company, even if they were like full-time, professional, really good angel investors, basically disagreed with it. It was like so fascinating that it was like such a clear line between anybody who'd done the company said yes, absolutely.
Yeah, it's a huge difference. And it's actually funny because I was talking to the founder of a company. He'd left a company that Facebook bought, and he was an early engineer at the company, and he kept complaining to the CEO saying, look, like, why are you getting so much more equity than me? I'm taking on as much risk, all this other stuff. And the CEO told him, you should go start your own company and see what it's like, and you'll realize that it's really fair. And so then he went and he started a company, and the CEO angel invested in it. And so I met up with this founder, and he's like, oh my God, he was so right. It's so different.
It's really funny how like actually doing the company changes your perspective on this so fundamentally. It's really fascinating. Yeah. Okay, so maybe this is a good transition actually, talking about angel investors to switching into the other half of your life, or I guess you really work 2 jobs, and so it's the other life. So you've been this amazingly successful angel investor. Can you talk maybe just starting high level, how you think about investing at a high level and your philosophy to investing?
Sure, yeah. I think most angels are very people focused. I'm very market focused. So I think great people in terrible markets get crushed by the market on average. And terrible people in great markets sometimes do great. And there's a number of examples of that in Silicon Valley of just awfully run, bad companies, terrible HR issues, everything's broken, and they have a multi-billion-dollar company. And it's largely just driven by product market fit. And then there's the last piece of it, which is, great teams in a great market really do something magical, right? That'd be like a Google or something where you're like, wow, like they've taken advantage of the situation to the utmost degree in the most positive way. So I'm a very market-driven investor. In almost every case, there have been some examples where I've said, you know what, I'll just take a flyer once and try it out, or a few times. But on average,
how's that worked out for you?
On average, very badly. And I mean, it could be I'm a bad judge of founders, or it could be that on average markets matter. So.
Interesting. So okay, so that's the number one characteristic
Yeah.
you look for. What's the number two characteristic you look for?
I mean, it's really market, and then it's probably after that it's founders, and then the last thing would be not just are they good founders, are they ethical? Would you take their call? Late on a, I've literally had the founders of Stripe call me at 10 o'clock at night on a Saturday and say, hey, can you meet for a drink? We're thinking of buying a company. How do you do that, right? For their first acquisition. So, you want to work with people that are ethical and that you view it as being a long-term relationship with, because, some of these things turn into like 9-10 year journeys, and some angels drop off, early on, and some keep going. And if you keep going, you're going to be talking to those people for 10 years, so.
Well, optimistically, it is actually a 10-year journey. Yeah. Right? Like if the company's successful, you want them to be around for a decade plus, yeah. And so. Yeah. So if number one and number two are markets, what are the markets that you're really excited about right now?
Yeah. So crypto is obviously one. So I'm super excited about where things are from a pricing perspective in terms of some of the public tokens. Well, that's not investment advice, obviously. So it's more just personally. Yeah. I'm very excited about CoinList. No, I'm just kidding. I'm extremely bullish on crypto and sort of multiple substantiations of that. I'm really excited about sort of the no-code consumer world right now. So I think basically, if you look at a lot of spend that big enterprises have, it's basically going to Accenture and Capgemini and companies like that. And it's being eaten away on one side by the Airtables of the world in terms of just simple templated self-serve apps effectively that you can build yourself. And then on the other side by RPA and sort of the UiPaths. And I think those two things are sort of eating away at the center, which is...
Can you define RPA for everybody?
Oh, sorry. RPA is robotic process automation, which when I first heard that, I thought it was like robotic arms like doing something. But what it really means is you're automating certain types of manual tasks. And one way to think about it is almost like you're layering an API on top of any other software product. So for example, you'll download a client and then you'll be an SAP or something, and you, as a just average white collar worker or blue collar worker, you don't need to know how to code at all. You can sort of select some boxes and take some actions, and then it'll repetitively do that for you based on some preset criteria. So effectively, you built an API. So it's almost like providing API access to the world of people who would never be able to write code. So I think that's like a really interesting trend. And so Accenture will come into an organization and write a $5 million app that is some broken HR thing or some broken specialized CRM, and now you can just go on Airtable and build that yourself. So I think that's a really big shift in how the world works from a software perspective, and I think there'll be verticalized versions of that coming sort of as the next wave. So that's a biggie. There's a lot in real estate technology. There's a lot of areas actually I think that are interesting right now. Supply chain and logistics, like a few places.
Gotcha. Can you drill into crypto a little bit? Like what exactly inside crypto are you excited about? Or
Yeah, I'm excited about a few areas. So I'm still excited about privacy. So Beanstalk is very exciting. So let me take a step back. I view it as sort of the token world and the infrastructure world in terms of, and by infrastructure I mean companies. I don't mean other aspects of infrastructure, although that's obviously very important in the sort of token or layer one world. On the layer one side, I'm really excited about the standard use cases: store of value, fundraising through either ERC20 tokens or other mechanisms. And I think honestly that's one of the big values of Ethereum that people don't talk about enough. Securitization of different assets, like what Harbor or other people are doing. Privacy is mentioned. There's obviously really cool layer 2 stuff, like what Elizabeth's doing on the Lightning side. And so I think there's cool things happening there. And then I think there's sort of the new financial stack being built between things like Coinbase, Anchorage, Bitwise, Tagomi, et cetera. So I think there's a whole suite of companies and services that are doing pretty interesting things in terms of providing sort of the future infrastructure for the space.
Gotcha. There are sort of, you talked a little bit about kind of you're optimistic about long term, but we are sort of hopefully at the tail end of a bear cycle. You talked a little bit about Plaxo, and you were at Google really early, sort of post-crash, post-2001 crash, and you were at Twitter kind of post-2008 crash. Do you have advice for founders that are in this sort of post-crash, post-correction era?
Yeah, I think there's a good saying that goes something like, and I'm going to sort of say it wrong, I think, but you should always take advantage of a good disaster when it happens. And fundamentally, down markets can be extremely hard. It's much harder to raise money. It's harder to hire people. It's harder to do a variety of things. So if you're at the very early stage of something, it tends to make the early stages tougher. The flip of it is there's less noise. If you're selling something, there may be more room for you to actually do it because there's not going to be as much competition. It clears out a lot of the sort of forest in some sense. So early, it's really about, can you take advantage of it more from the perspective of gaining momentum when there isn't a lot of competition around, and where you can capture more things and build brand and do all the things that you can do and nobody else is doing it because it's cheaper to do it. I think for a late stage company, it's a magical time, because that's when you should be going out and buying up everybody else that's valuable or good. I'm totally serious. I think there's a handful of major crypto companies that if I was them, I'd just be rolling up everything. I'd basically say, what's the chessboard, and let me buy every single piece on it, including ones that may turn out to be bad, but that's fine as long as I have the right portfolio of stuff. It's almost like viewing it as an investor and saying, you know what, I'm going to buy, I'm going to take 20% of my market cap and just buy everything. And that way, when things come back, nobody has access to those strategic pieces. So, I think it's a very exciting time if you're running a big company.
Yeah, and it's actually, this is exactly what Google and Facebook did. It's like not a coincidence that they got to the scale that they did post 2001, 2008. Yeah, super smart. Actually, sort of that dovetails kind of with an interesting question of, even if crypto is in sort of, hopefully it's bottomed and is coming back, and it's going to be a good time 5 years from now. How do you think of that in the context more broadly of Silicon Valley? Like, is Silicon Valley, they could be at a phase shift, right? Like, crypto could be on an ascent while Silicon Valley may or may not be. How do you think about the relationship between those two and kind of where we are more broadly?
Yeah, I think they're kind of separable. So I do think that there's going to be really outsized companies built in crypto in general. So, and I think they're just kind of part of Silicon Valley in some sense. And then separate from that, there's things like Bitcoin, which, it's almost like all the companies that benefit as an ancillary benefit of the fact that this open source thing is working so effectively. In terms of Silicon Valley itself, I do think that we have a few countervailing forces that are sort of fighting each other that are preventing any big downturn. I think on the one hand, we've sort of run out of big trends that are true why now statements of why certain companies should exist. For example, when iOS came out, there was half a dozen companies that got built that just could only have existed once you had a smartphone, right? And that would be Uber, and that would be probably WhatsApp and Instagram, and if there's a few very giant services that came out of that, and they couldn't have existed 5 years before. So I think there's fewer why nows right now. The flip side of it is, I do think that there's both more capital in the system, which is both good and bad. I think it's keeping a lot of companies that should die or exit from dying or exiting, and I think a lot more founders should actually be selling their companies, which in some sense is a contrarian piece of advice, because people always say keep going no matter what and keep grinding away, and and honestly to me that's VC optionality, right? It's good for the VC if you keep going in case you hit something because they've already written you off. While as a founder, it's real opportunity cost, right? It's your life. And so I think you should figure out, should I exit? And not just that, maybe you'll make dramatically more money by exiting than if you kept going. It's better to sell something than to shut something down. I think companies with too much because there's so much capital, just keep going forever. And I think some of them should just say, okay, it's time to call it. I think that the flip side of it is the internet has continued to grow at such a nice compounding rate over the last 5 to 7 years that it's actually never been easier to build a $100 million revenue company, because things that used to be $20 million businesses, they'd be small and subscale and all this stuff, suddenly can be $100 million businesses without any change. You just can reach more customers online, especially if you're doing SMB or consumer products or whatever it may be. And so I think that's the reason that people are saying, oh, Silicon Valley's over, because look, there's one company in Atlanta and there's two over here and Europe has a couple. And so, therefore, it's no longer a dominant area. And I think that's completely false, and we can talk about that if you want. But I think fundamentally, it's never been easier to build a billion-dollar company in some sense. It's still really hard, just because you can get to volume like you never could before, simply because the internet's a bigger place. So I think people have kind of missed the macro on that. I do think there's going to be fewer $100 billion companies because, again, there's no fundamental why now shifts. And the businesses people are entering are harder businesses from a technology perspective. But
can you talk about the Silicon Valley has peaked thing or has not peaked?
Sure. So every industry has industry towns, right? So if you want to make movies, you go to Hollywood. People don't say, oh, you should go to Atlanta or you should go to Austin, Texas and make movies because there's a few movie makers there. They say, go to Hollywood, right? If you want to go into financial services, they're like, go to New York or Hong Kong or London. And the list goes on for basically every industry. And then for some reason, when it comes to tech, people are like, oh yeah, you can do tech anywhere. And you're like, really? Like, why is it different? And I think clusters matter. I think professional services matter more than people think. Actually having lawyers and accountants and banks and all the rest who know how to support your business matters. I think having experienced executives who've scaled things before and having access to them matters. Having access to real capital and models matters. And then lastly, a lot of companies end up selling to each other or partnering with each other, and they're all sort of local. And so you have these effects where you run into somebody at an event, and it sparks something that ends up being really valuable for your company. So I think clusters matter on multiple levels. And Silicon Valley is a giant tech cluster, obviously. I think Beijing is obviously one. Bangalore is sort of resurging now, in part because of sort of the shifts in mobile telephony there that have been really fascinating watching that. And the real question is, does Europe have a cluster yet or not? And I think it's still an open question. There's, again, many more companies that are going to hit $1 billion out of Europe, and then there's obvious things like Adyen and Klarna and Spotify, but it's just unclear to me that, for example, there's some massive shift there because all the best European companies either move here or end up raising money here.
Yeah.
How do you see venture evolving?
I think venture capital, oh sure, yeah. So the question was, how do I see venture evolving? And I think venture capital is shifting in 3 ways.
3.
Okay, 4 ways.
You bought himself some time to come up with a 4th.
Yeah, I know, right? 2 ways. So one is, so it's changing and it's not changing. It's not changing in that branding really matters. And I think people misunderstand the degree to which branding matters. And if you look at some of the biggest names in venture capital, they all have blogs. Fred Wilson has a blog. Mark Andreessen for a while had a blog. Ben wrote a book as well as has a blog. Like you just run through the list of the people that you know and identify on sort of a first name basis. Oh, it's Reed. And you're like, oh yeah, he has like 3 books and he was blogging and he did all this, content marketing effectively. And so, and then you know of people that haven't actually done great investments, but you know their name because they've sort of done content marketing. So I think branding matters immensely. So that's point 1. So that doesn't change, but it's one of the things that I think is important for venture. Number 2 is you do see this emergence of mega funds. And by mega funds, I mean more like Sequoia and Andreessen raising a $2 billion fund and all these funds getting bigger. And I think in parallel, you see sort of specialization down on the other side. And so a lot of venture sort of stretching into these mega funds and then niche or verticalized funds. And then I think everything else is getting squeezed in between. And I'd actually consider Benchmark a niche fund, for example. It's a $400 million fund, but they do one thing very well, which is mainly just Series A's. And I think more and more you're seeing that segmentation. I think the second thing is it's becoming much more distributed. And that's because of all the scout programs. It's because of things like AngelList. And I think there's a couple funds now that have that thesis. But I do think that we may see more and more of that over time. Some of those models I think will be very unsuccessful, some will be successful, and we'll see what impact that has.
Can you just define Scout program for people?
Oh, sure, yeah. A Scout program is basically where a VC will give you money to angel invest effectively on their behalf, and you split the upside with them. And so it, there's one Scout program that apparently has 50 or more people in it, right? And so it means that there's a lot of people that have sort of access to what, from a venture perspective, is small amounts of capital, right? For a person, it's a lot, but so a VC will give somebody $100,000 to invest in like 4 companies or something.
And it's often like the founders that.
Yeah,
of that
it's
fund.
founders, or increasingly I've seen it be, different VPs, or in some cases product managers or engineers, and so I think it's sort of trickled into a variety of different levels. And a lot of people that I've talked to who are scouts unfortunately actually view that money as just free money. They're like, oh, it's optionality. I can invest it wherever I want. It doesn't matter. It's how I learn about investing. And what they don't realize is that anytime you start investing in things, if you ever want to join a VC or raise a fund, you're creating your institutional track record. And so a lot of people may actually be shooting themselves in the foot by being scouts and then just kind of throwing the money around. So I think that'll be an interesting thing to see how it shapes up. One thing I would do if I was a venture capitalist, so a lot of VCs I know are ongoing looking for partners, but they just can't find anybody good, which is really weird because it's an incredibly lucrative job, right, for people to do. And they say, well, I can never meet people and track record and this and that. And you're like, well, how can you identify whether somebody's good or not if they don't have a track record? You know, it really limits who you can talk to or look at. And so if I was a venture fund, I would basically tell my scouts, the thing that you win at the end of this is a job with us, if you're a firm that you actually want to join. And I just run it as a competition and see who did the best job. And I think one of the big myths in Silicon Valley, at least on the venture side, is that it takes 5 years to know if somebody's a good investor or not. And I think at least for angels, it takes about 18 months or 24 months. You can look at their portfolio and they've done enough investments usually as an angel and you're like, okay, this person has a good hit ratio or they have a terrible hit ratio. So I would just run a bake-off if I was running a scout program.
I mean, it's pretty sizable. I mean, people get really excited about like $1 million lottos, and that's, I mean,
yeah.
the prize here is like way bigger.
The prize is big. And the one other thing, sorry, that I'd do if I was running a scout program, and sorry, I know that wasn't the topic, is I'd actually make people invest their own money alongside. Because if you have skin in the game, you're going to think about it pretty differently than if it's just optionality. You're like, oh shit, I don't want to lose that money, you know?
So within crypto, what are your thoughts on the trend with stablecoins and tokenized assets?
Can we repeat the question?
Yeah, so the question is, with crypto, what do I think about the trends towards stablecoins and tokenized assets? So I think both are really interesting and really promising. You know, I guess Maker is the one that has the most activity right now, though the relative activity is smallish, which is true of most things in crypto. So it's not meant as a negative, but more just, you know, a lot of things are early. You know, fundamentally, I think stable coins are going to be really important. And obviously there's things like tethers where, you know, you're creating a stable coin through USD or other regular assets, or there's things like Maker where you have sort of a more collateralized pool that you can use. And it's unclear to me in the long run which approach makes the most sense or works best. Just because I just haven't gone deep on it. I'm sure people here in the room, I mean, there's Cello and others who are, you know, obviously very savvy on all this, who may have more insights than I would on this, on the stablecoin in particular. Stablecoins in particular, it's obviously going to be very valuable. The question is, you know, what works? I think in the long run, it's quite possible that one of the primary types of stablecoins that exists will be the basket of the biggest cryptocurrencies by market cap plus all the hedged derivatives. To allow you to hedge them within a certain range, because you can effectively create these synthetic instruments that'll move within a certain area in other asset classes, right? So you can effectively create a synthetic stablecoin if you really want to, assuming the market is mature enough. And so
A lot of liquidity.
you need a lot of liquidity, but if fundamentally it's you know, Bitcoin, Ethereum, and 2 or 3 other things, and it may not be those things, right? I mean, there's a reason that NEAR exists, right? Then you may have the market cap and the eventual long-term stability. Like, in other words, when crypto becomes as a basket a multi-trillion-dollar asset class, which I think it will, I think potentially it may be less volatile than when it's a much smaller asset. And so you'll have a more stable asset that you can then hedge in different ways, and then I think you can create more stability through that as well. But we'll see. So that's stable coins. And then in terms of the sort of securitization side, I think it's a really exciting area. You know, I think what Harbor has been focused on in terms of real estate has been super interesting. And I think that in general, the ability to create 24/7 global liquid access to all sorts of different investable assets is, you know, a massive shift for society. So I think it's really exciting.
Elizabeth in the back.
So I know we talked a little bit about Silicon Valley versus, say, elsewhere around the world, but, you know, many of us here in the cryptocurrency world, it's very international, it's a global phenomenon. For example, I don't know if anybody heard about the whole Craig Wright attempting to sue an inbred space cat in the past week, going by the name of Polonaut, but was working with somebody from, I was making memes in Shanghai, some developers in Chicago, Romania, like elsewhere in Europe, all sorts of different time zones, like it's global. And even for my company, we have engineers in Europe, somebody's traveling around Bali, we're all over the world. And if we just had to say only hire here in the Bay Area, that would be very limiting because a lot of the community is based in Europe and South America and growing in Asia. And there are like multiple wallets in China doing all this. So how do you see the global nature of especially the cryptocurrency world as in comparison to, say, the strength of Silicon Valley? Especially to me, Silicon Valley is often a mindset like, oh, how could people not know that elsewhere? I know that even if I'm not physically there. And how do you see companies scaling up when you can't just be limited to, say, hiring here in the Bay Area?
Sure. Yeah. So I think the question was, how do you view the decentralized nature of talent, particularly in the cryptocurrency world, but more broadly, relative to what was talked about earlier in terms of centralization? And overlapping with that is like a Silicon Valley mindset versus having to be here. So I think people can definitely start decentralized companies. I just think it's harder. And to your point, it's harder to hire here in some ways, but in the companies that I've seen that are really well run, that are decentralized, like a Zapier, right, or GitLab is entirely decentralized. I'm an investor in GitLab, for example. The challenge is that you have to do a lot of things really early that normally you'd have to wait until the company was 1,000 people to do. You have to be much clearer on goal setting. You need to think about communication much more thoughtfully. You need to think about hiring much more thoughtfully. Like, there's a lot of shifts where actually if you're doing it very well, I think you end up with way more process than you would at the same scale of people if you were just centralized. Because you need to have process make up for all the issues with communication and collaboration and alignment and all the things that come up normally as you hit a certain size. So I think you can definitely do it. I just think it's a lot harder. And it's that trade-off of what's harder for you to hire people or to do it. I think crypto in particular started with obviously extremely decentralized roots and a very strong both open source and hacker ethos, which exists less, I think, in most companies. And so I think that's one of the things that enabled it to be decentralized. I think for some, especially layer one teams that I know, it's really starting to backfire now. And so I see a lot of chaos in 2 or 3 organizations where they've rejected both process as well as centralization. And I think it's really biting them in a really bad way right now because they don't have alignment, they don't have process, they don't have management, they don't have all the things that I actually think you need if you're going to be decentralized. And so I think if you choose it, I think you have to embrace it. And I think some people just don't embrace it properly, and some people embrace it very well.
Do you think this also makes you less nimble if you're decentralized and you have all these processes actually set up? Like you cannot kind of adjust as quickly as you would have.
I think it's harder because you also lose some of the side conversations that you normally have more in the social context versus in the official work context. And I think those conversations are incredibly important. And sometimes you change direction, you come up with something because you're just hanging out with somebody that you're working with. So I do think you lose a lot through that. I think camaraderie tends to be harder, and some companies are more or less focused on that as something that's important. But yeah, on an average, and this is a personal statement, I would much rather centralize a team and then once it hits a certain scale, have a centralized pocket somewhere else than be decentralized, but I'm also showing my age perhaps. So, but personally that's what I would do because I just think it's easier.
You mentioned that if you were one of the more established crypto companies, you would be buying up a lot of smaller crypto companies.
Yeah.
How should we, as founders of smaller crypto companies?
Yeah. It's a good question. I think one question that I think founders of small companies should constantly be asking themselves is, do I want to keep going? Am I excited about this? And as founders, we all go through periods where we're terribly unhappy, and that's normal. So that's just part of the journey. So I think I'd put that aside, because otherwise everybody would exit immediately. And I would more just ask, is now the right time? And the right time may be, I don't think what I'm doing is working, and I could raise more money and keep going, but maybe I shouldn't. And how do I want to land my team somewhere good? Do I want to work somewhere where I think I could have more impact than what I'm doing today? And there's also the financial question. I think if you do sell, my number one piece of advice is hitch yourself to the company that's going to 3x, 10x, whatever it is, because people tend to under-realize the degree to which there's upside sometimes if you sell to the right company at the right time. And the flip of it is realize too that you should go somewhere that you and your team will be happy, because if you go somewhere that's growing really fast but you leave after 6 months because you hate it, you're not going to invest the equity that you would have gotten anyhow. So I don't know if that answers the question.
There's some great examples of this too. I mean, I think you guys did a great job with identifying Twitter as an option. FriendFeed did a great job of identifying Facebook as an option. And sometimes you run those multiples and it's, like a quote unquote small acquisition at 20 million times 10 is a $200 million acquisition. And then so those numbers get real.
Yeah, and you also haven't diluted
Yeah.
as much because you haven't raised all these rounds of funding, and it helps you and your team from a branding and career perspective, because having that exit suddenly makes you a repeat founder, or it makes you somebody who's been successful somehow. So I think, and same with your team, right? They joined a company that actually worked, and in some cases they'll come in and they may be some of the best people at the acquirer, because often startup teams are these strong sort of focused teams, so they may have great careers.
Questions? John?
You talked a little bit in the beginning about how the nature of VC is changing. I think a lot of things are happening. There's a lot, for example, to the seed stage, now there's angel investors, Series A funds that are dipping down, there's seed funds, there are ways to have a fat startup, lean startup, and there are all these permutations. And do you have any advice in particular of, if you're a first-time founder, you haven't raised money before, and you don't know what's going down the line, any kind of advice on what to look out for, or what to look for in a investors partner?
Yeah, I think.
Repeat the question.
Oh, sure. Yeah, sorry. So the question was, there's a lot of shifts in terms of multiple different types of capital, particularly for the seed stage. What should you optimize for? And I'm not going to say 3 things because Avichal will make fun of me. I think there's between 3 and 5 things that you can optimize for. So number 1 is I would definitely background check them / talk to other founders that they've backed and ask what happens when things go bad versus good, and just make sure that they're people who are going to be stable and thoughtful and all the rest of it. 2 is, can they help or not? I don't think founders will make or break your company, but I think some of them can be more helpful than others, and some can be actively destructive. 3rd is, I read a blog post once about how I think there's 7 different types of startup investors, and I won't bore you with it, but the takeaway on it is, there's people who are great at company building, people with great networks, people with industry knowledge, people who can help you with company building, later stage rounds, whatever it is. And you want to view the people for your seed in particular as almost a portfolio over time. What is a set of skills that I want on board that I can't hire in, but that I can get help on? So I kind of view it that way. I think branding matters in terms of attracting employees. I think it matters less for customers, although some people think it'll help them with that. Yeah, I think those are sort of the main ones. I don't know if you'd add anything, but.
How about number of investors?
It's a toughie. I think it depends on the type of product that you're doing sometimes. I'd say somewhere between 3 on the very low end, probably more 5, up to a dozen is reasonable. I've seen some companies with 40 people for their seed, and I think it just gets onerous in terms of managing all the people. Or when you exit, sometimes there may be more tax efficient structures that require 100% shareholder approval, and so then you're chasing down 40 people, some of whom are on vacation or hiking or offline or whatever, and so it's sometimes hard to just coordinate all that. One way that I've seen people work around that is they'll basically run a no-carry angelless syndicate themselves, where they'll aggregate the 30 people into one vehicle, so only one vehicle needs to sign. So I've seen hacks around that, but fundamentally I think somewhere on the order of 5 to 12. If you do have a VC lead it, I would definitely make sure to include angels, because sometimes the VC incentives are very different from your own, and the angel incentives tend to be closer. And so they'll often help you if the VC doesn't around certain aspects of your company.
Probably the only other one I'd add is it's a little bit of a dark art, but there is a dollar amount that makes each investor care. So for an angel investor, it might be $25K. For a VC fund, it might be $1 million. And if you give that VC fund $100,000, they actually just don't care. Now they have option value. They get to see your investor updates, and if you knock it out of the park, they can preempt the A, and so it's great for them. And you actually get very little value out of it. You're not going to get any time. And so there's a little bit of this is actually, I think, where angel investors are really valuable, is they can help you sort of navigate. Oh, actually, what you should do is not give this person $200,000. You actually only need to have an allocation of $100,000. And if you take the $100,000 and give an extra $100,000 over here, that's going to really, really get this person jazzed about it, and now they're going to give you all the time in the world. And so there's actually a little bit of a balancing act of how do you size the allocations appropriately.
Another question.
So you talked about how market's important, and I've read your blog posts around, look for new technology or a market that looks crowded but isn't. I'm curious about, when you're talking about logistics or supply chain or crypto or real estate, what process have you personally followed to identify a market as interesting, and how should we go about that?
Yeah, so the question was, how do you identify interesting markets and what are some signals for them? I think one signal is just what are really smart people doing, and it could be especially smart, slightly weird people, or people who are just willing to sort of buck the trend, or the person who's always on to the next sort of cool thing. And I think that's actually often an interesting leading indicator. There was so many developers working on crypto when nobody was talking about it, relative to sort of the total population of other things that people could have been working on, that there was signal there that something interesting was going on. So I think that's sort of one big signal. I think the second one, if you're doing more like SaaS or B2B things as an investor or as a founder, is what are the things that your friends are starting to adopt as founders, as pieces of technology or things that are broken that everybody's complaining about. You're getting dinner and everybody's complaining about something. You're like, oh, maybe that's an opportunity. So I think often as well is just sort of driven by what you yourself need. I think you can also do it more analytically. I think that one of the big myths of Silicon Valley is that founders need to work in that thing that they always dreamed of since they were little. And I don't think anybody ever dreamed of working on ERP when they were little. Some 5-year-olds I really want to do ERP. Do people know what ERP is? Okay, a subset do, a subset don't. It's enterprise resource planning software. So it's basically software that helps connect a bunch of different sort of plumbing in your business between finance and a bunch of different areas. And so it's not like some 5-year-olds, I would love to build this stuff. And there's all these founder myths, and I think that's part of the problem. The press often wants to write about the personal story of the founder instead of the company. And so the founders invent these amazing myths of how ever since they were 7, they were, Brian Chesky was letting people live in his house when he was 7 years old or whatever it is. And so I just think some of this stuff gets rewritten. I think it's more sometimes you can be very analytical about it. And for example, I would love to do the analysis of what are the things that Fortune 500 companies consistently keep having to deal with or build themselves. And Checker is a great example, right? Background checking API, massive service, great company. And I think there's a dozen of those, right? Where it's just simple things that people have to repeatedly do at scale that if you provide it for everybody else, it'll be really valuable.
You're familiar with Keith Rabois' top-down, big companies NPS approach?
Yeah.
There's another one that I really like, which I think is Keith Rabois, which is you find a market that's highly fragmented, that's massive. You can go look at the size of the companies. It's they're $10 billion plus companies, and the NPS scores are really low. So you talk to their customers and they hate it. So when you have this perfect intersection of highly fragmented market, really, really large companies, but actually the customers don't like the companies, that's a great place for a startup to start going and poking around and see. Look at something like Open Door. Real estate is massive, mortgages are massive, but nobody says yes. I love. Yeah, I had such a wonderful experience with. I'm not going to name any names, but people. That's not something people say, and you can look at the NPS scores actually top down and identify markets that way.
Except for EdTech.
Well, that's a whole separate.
So
Don't do an ed tech company is the TLDR.
Are you guys reading market research, documents and stuff, or is this more grassroots, talking to founders, and how do you actually conduct this research of seeing whether there's low NPS scores or an industry's fragmented?
I have some thoughts about it.
Yeah, you should go for it.
Well, I think the hack, so it's a little unfair actually. The investors have an unfair advantage in this, which is the hack is you go find really smart entrepreneurs who have done the work. And so actually a lot of times what you're looking for is signal from a founder as an investor is, somebody went and figured out that this market exists and did that research of, hey, look, there are 5 $10 billion companies, and we just did some surveys on how many people would use that product again, and the answer was 0. And you're like, wow, you found the inefficiency in the world. Thank you, here's money. And so actually it's, from the investor's perspective, it's actually a lot easier. I think from the founder perspective, it's a lot harder because you have to often go poke around in areas that seem non-obvious. But that's kind of, I think, the mark of a really great founder is like they've somehow managed to find this sort of counterintuitive thing in the world, and they did the legwork to go figure it out. And often it's non-trivial legwork. It's like somebody had to go poke in some underserved area or some market that nobody was paying attention to. I don't know if you have other thoughts.
Yeah, no, I totally agree with that. I think in general, for a startup to succeed, it has to work on something that's not obvious. Because if it was obvious, everybody would be working on it. And so there'd be no opportunity. So to your point, it has to be something that isn't just crystal clear. And some of those things are crystal clear in hindsight. You're like, oh, of course. I think one of the big dangers that investors run into is if they become extremely thesis-driven, because most investors' theses are wrong, right? And so that was clean tech, right? Like everybody was like, oh, the internet's over, and we need to find something else, and energy's a giant market. We should go do that. And a bunch of firms lost tons of money just investing in an area that they invented. And usually founders, if you think about it, if there's tens of thousands of founders and there's, 100 VCs or 1,000 VCs or, 10,000 VCs, it's just order of magnitude difference in terms of, or 2 orders of magnitude. Like there's probably more smart people not running venture funds, which is obvious, but, I think that also impacts things.
Actually, piggybacking on that question, do you have thoughts on novelty of idea? Like if some smart founder figured that out, so that for the investor, it's like, oh, the smart founder figured out that there's this massive market, fragmented, huge companies, low NPS, clearly I should give this person money. But as a founder, should you just like fast follow and say, oh, this person found this huge market that's, like, how do you think about that?
Yeah, I think actually too many founders have too much pride of invention, which is one of the reasons we're all founders, right? Like that's why you start a company. And then you see something really magically working and you're like, oh, I can't copy that. I need to do my own unique spin on this thing, and then you screw it up. And so actually I think that's one of the big things that people screw up all the time. And you actually see like really outstanding teams that could go and crush whatever crappy company started something, and they have too much pride to do it. And I don't know if they should. Steve Jobs was a guy who said great artists steal, right? So.
Is there a rule of thumb, you think? Is it like, if you see a seed stage, Series A stage company that's really crushing it, that's like prime, you should fast follow and out execute, or by the time they're at Series D, it's too late, or like, how do you think about that? Is there like a window where it makes sense to do that, a window where it just doesn't?
It's a really hard question around when does something truly have both escape velocity as well as defensibility. And if the thing isn't very defensible and you could catch up in 3 to 6 months and 5 other people are going to do it and it's going to be a commodity market. So part of it as well is figuring out what actually has defensibility, but that you can overcome the barriers that the person has put in place so far. Or can you do a slant on it that creates a defensibility if there isn't any? So I think a lot of people don't think a lot about defensibility when they should. How do we protect our moat? Yeah. And so I think part of it is that, how hard is it really? What's the defensibility? What can we do that's unique? What's going to prevent 3 other people from doing it?
So that would imply actually that a lot of businesses that look unassailable, actually from a founder perspective, you could actually run at, even when they're worth $150, $200 million, they're actually still very vulnerable.
Oh, totally, yeah. Because there's a lot of companies that sort of do that and then they kind of fall over, or they blow up, or they do a bad job of sort of doing the next thing that's really important. So you do see a lot of companies stall out much earlier than if they were well run. So I think the other piece of it too is there's a lot of markets that look really crowded, or it's already game over, and then there's tons of room left. I think social networking was a great example of this. Everybody was saying in 2010 that their social's done. There's Twitter and Facebook and LinkedIn, and we're kind of done. And then suddenly you really see the rise of WhatsApp and Snapchat and Pinterest, and so it's just, and it was supposedly game over. Yeah, Instagram, and so everybody was calling game over when those companies were getting started, at least on the social side. So I think there's often a lot of room.
Maybe one more question.
Yeah, an increasing trend of repeat entrepreneurs and founders that are just surveying the landscape of all things that seem like they're trending up and to the right, and then pouncing on those opportunities with like a track record, funding ready, team ready to go.
I see less of that in terms of them just saying, oh, somebody else is doing it, so I'm going to jump on it. I think there was always some of that behavior, but I think in general, one of the things that serial founders run into, and I also see it happen with people who are entrepreneurs in residence at venture funds, where they sort of come in to start something, is that they kind of aim too high. They say, well, my first company was a $100 million exit, so I need to do a $1 billion exit, and so I can only look at $1 billion ideas. And most things, again, are non-obvious, and you're like, I'm going to do this thing. And I guess to take a big step back, I think founding a company is almost an act of desperation. right? Like the reason you start a company up to a point, and there's people who are always just going to start companies. Like Max Levchin will always start companies, right? But there are people who start companies because there's no other way that they could accelerate what they're doing in life faster, right? And that's most founders. That was me when I started a company, right? Like I could have joined as like a director at some company, or I could have started a company and hopefully had a much faster trajectory. And so I think founding a company is the fastest way to try and jump the system, right? And if you're really successful already, why put yourself through that terrible pain of starting and running a company? It's like awful, in my opinion, right? It's really hard. And so I think, many serial founders are like, oh, in order to make this worth it for me, I need to do something so massive. And then they get kind of frozen trying to find that massive thing instead of just screwing around with something interesting. Or alternatively, just saying, you know what, I'm going to build this niche thing and see how it grows, because again, it's going to be kind of non-obvious up front. So you have to have that willingness to dig around, and second-time founders sometimes don't have it. Entrepreneurs in residence very often don't have it because they're sitting with a bunch of venture capitalists who are going to be more risk-averse in terms of the way they assess new business ideas. And they should be. I mean, that's kind of their job. Yeah. Elizabeth?
What do you think of the trend of early-stage founders doing like investing on the side, be it with certain funds or starting their own funds? I've seen a lot of people commenting on this on Twitter lately, and I know, like, as a founder myself, I'm kind of like, do I have the time to devote to help the companies if I'm actually going to invest? So I personally think
Yeah, so the question was, what do I think of first-time founders raising funds or investing or doing other things?
Or even just early stage, maybe they're doing it.
Sure, or early-stage founders doing it. I think I don't have like a monolithic view on it. I think it's trade-offs, and I think it depends a lot. For my first startup, I didn't have the money to invest, and then I also was really focused on my first company, and so in that case, I think I took 1 or 2 advisory positions, and maybe I made 1 investment, and that was it. And it's possible that if a scout program or something else had existed at that time, I mean, there was a bunch that existed, nobody asked me, right? But it's possible I would have done it. It's possible I would have just said, you know what, I need to focus. I'm not sure, because I haven't had that happen to me. I think I do see a lot of very bad advice being given by angels who are like a year into their startup, and they really don't know a ton about what's coming, and they're giving advice to people about what's coming. So I've seen that act badly for the founders that they're funding. But I've also seen some really great operator angels who have been extremely helpful both to me when I was starting my own company, as well, both companies that I've started. And so I do think that the operator angels, people who've started things, who know what they're doing, actually can be incredibly valuable. And I really hope that they stick around, because I think that's some of the most useful capital out there. And so the real question is, when is the right time for you to do it? And if you do it, how do you carve out the time so that you don't screw up your own company? And so that means, the way I often put it is, you should treat it as a hobby. If you don't treat it like a hobby, so say for example, you wouldn't go and do like a 200-hour yoga teacher training in the middle of work every day, then you probably shouldn't do that as an angel investor, right? You should say, you know what, I'm going to do it every Tuesday night and then my Saturdays, and that's it. And that's how I'm going to contain it so it doesn't bleed over. Because as a founder, you only have so much time, and you need to be able to make the time to make sure your company is successful, and it can really interfere. So I think if you do it, you should really carve out strict rules in terms of how you're going to do it.
Thanks everybody for coming. Grab a book if you don't already have a book. Thank you so much.
Yeah, no, thanks so much for having me, and thanks for everything.